6.65% against 3%. That is what a new mortgage costs today against the loan you are already carrying. And on a 30-year loan, that spread costs about $220 a month for every $100,000 you borrow. The average outstanding mortgage balance in this country is $264,162. So the gap is roughly $580 a month and about $105,000 over 15 years. That is the number everyone quotes. It is also less than a third of what giving up the cheap loan actually costs. On a like-for-like move, same value roof, on both sides of the trade, 2026 costs, 2026 rates. The real figure lands closer to $375,000 over 15 years. The interest rate is the small piece of that. Let me build the thing that produces the other $270,000. Rules. Because a scorecard without rules is a sales pitch. You own a $500,000 house. You refinanced in 2021 into a 30-year at 3%, which was normal, not clever. The 30-year first dropped under 3% in July of 2020, bottomed at 2.65% in January 2021, and averaged 2.96% across that whole year. Millions of people did what you did. Roughly 1 in 5 outstanding American mortgages still carries a rate under 3%, though the share sitting above 6% has now passed it. You have $265,000 left on that loan. Your principal and interest is $1,265 a month with 25 years to run. Column A keeps it. Column B sells and buys an equivalent house, same price, same neighborhood, same square footage. Replacement housing in both columns. This is not the paid-off house sold and swapped for rent. That is a different question with a different answer. And grafting its verdict onto you is where this whole argument goes sideways. And because both columns own an identical $500,000 roof, appreciation cancels. Whatever housing does over the next 15 years, it does to both of you in the same amount. It cannot decide this. That deletes the argument everybody wants to have and leaves two rows that matter, what you owe and what you own outside the house. So run column B's closing statement. Commission first. The nationwide average total commission in 2026 is 5.70%, up from 5.44 last year, a 5-year high on the median sale that runs about $20,374. Add title, transfer tax, attorney, the repairs the inspection produces, and total seller costs land in the 8 to 10% band. Take the friendly end. 8% of $500,000 is $40,000. Pay off the $265,000. You walk to the closing table with $195,000 in cash. Now buy back in. Buyer side closing costs run 2 to 5%. Call it $315,000. That leaves $180,000 for the down payment. $55,000 of your equity has already evaporated on day one, before any market did anything at all. Quick thing while we are on friction, because it is the exact category that never appears in a retirement projection. I wrote a digital book called The Exit Code, and one of the things it does is put the costs that don't show up on a statement back into the arithmetic. Transaction friction included. Links in the description. Moving on. $180,000 down on $500,000 leaves a new mortgage of $320,000 at 6.65%. Fresh 30 years. That payment is $2,054 a month. Column A is paying $1,265. Difference, $789 a month. Your instinct here is the right one. Put more down and buy the payment back. Fine. To reproduce $1,265 a month at 6.65%, your loan can only be about $197,000. Which means the down payment has to be $303,000. You have $180,000. You are $123,000 short of standing still, which produces the quietest, strangest line in this entire comparison. On the same priced house in the same town, column B's new mortgage is $320,000. The one column B just extinguished was $265,000. You sold a house, paid off a loan, and came out the other side owing $55,000 more on an identical roof. That is not the rate. That is the friction. And the friction is permanent. By the way, if you like housing math with the vanity stripped out of it, clicking subscribe genuinely helps this channel keep running these. Thanks to everyone who does. Now the interest ledger, and I suspect you can already feel where it goes. Column A, over the next 15 years, pays about $94,000 in interest and ends year 15 owing $131,000. Column B pays about $284,000 in interest and ends year 15 owing $234,000. Part of that is the rate. A big part of it is that column B restarted the amortization clock. So those early payments are almost entirely interest again after you had already served 5 years of that sentence. Then the $789. Here's what I want you to notice about that money. Column A never decided to invest it. There is no discipline in this story. No budgeting app, no virtue. The money is not leaving the account. If it goes into a broad index fund at 8% nominal, which is the return I am modeling everywhere in this comparison, 15 years turns $142,000 of contributions into about $273,000. Close the ledger. Column B owes $103,000 more at year 15 and holds $273,000 less in the market. Same house, same neighborhood, same everything. About $376,000 of net worth. And the $105,000 from the cold open, the rate gap everyone argues about, roughly a quarter of the damage. You were negotiating over the smallest of the three forces in the trade, which changes what this conversation is actually about. Flip the number around and it stops being a cost and becomes a valuation. That 3% note is an asset, not a debt with a nice feature attached, an asset worth somewhere near $375,000 to a household that stays 15 years. It cannot be sold. It cannot be transferred to the buyer. It cannot be reissued because the window that produced it ran from July 2020 to roughly the end of 2021 and has not reopened. And it expires the day you sign the listing agreement. You have been carrying an unlisted asset on your balance sheet and calling it a bill, so attack it. Taxes first, because that is the objection I get most. Section 121 excludes $250,000 of gain if you are single, $500,000 if you file jointly, provided you owned and lived in the place 2 of the last 5 years, and you can use it once every 2 years. For most late career sellers of a $500,000 house, the federal capital gains bill is 0. Notice the direction of that. It helps the selling side. And the gap does not move. The IRS is not the friction here. The closing table is. Second attack, rates. 6.65% as of late August is not the panic number from a year or two ago. It has been grinding down. And I ran this comparison at the current figure rather than the scarier one, which means the trade was already scored at the number most favorable to selling. Third attack, appreciation. And this one is short because it is already dead. It cancels by construction. For completeness, the National Case-Shiller Index rose about 1.3% across 2025, the slowest since 2011, and 2026 is tracking near 1%. Housing is not rescuing either column. So why does the standard advice point the other way? Because most of it was computed on a household that has no mortgage payment. Get your equity working. Your house is your biggest asset. Those scorecards showing selling wins by 6 figures are real arithmetic. Honestly, done. On a paid-off house, swap for rent. Take that verdict, staple it onto a borrower sitting at 3%, and it inverts. Because the entire engine of the keep case is a payment gap that a paid-off household does not have. Nobody lied to you. There is also an incentive worth pricing. An advisor charging 1% of assets earns nothing on the equity under your roof and about $2,000 a year on it once it is in a brokerage account. That does not make anyone a villain. It does explain which assets get analyzed and which get filed under settled. Here's the part that never makes it into a retirement calculator. Knowing your rate is an asset and building a plan that spends it correctly are two very different problems. I spent a long time on the second one. The exit code is 8 chapters of research into 50 years of retirement data, distilled into a mathematical framework for leaving the rat race on a date rather than on a hope. 2 pieces of it apply directly to what you are holding right now. The 4% trap and the dynamic withdrawal method that replaces it, because a household carrying a below-market payment into retirement has a completely different safe withdrawal profile than the spreadsheet assumes. And the 58% rule, the buffer you need against a forced exit, which is the real reason a low fixed payment is worth more than its interest savings. It costs less than a dinner out through the link in the description. Now, back to the ledger. Because there is one structure where selling still wins, and I want to build it properly. Call this the equity landing test. When you sell, every dollar of your equity lands in exactly one of three places. Some lands in friction, which is gone forever and earns nothing. Some lands in the new down payment, which becomes house, historically compounding somewhere between 1 and 4.5% nominal. And some lands in the market, which has run about 10.2% nominal since 1926 with dividends reinvested, and about 7% after inflation. Only the third bucket outruns anything. Selling wins only when enough of your equity reaches that third bucket to cover the friction plus the extra interest. Quick one before the next case. If this kind of arithmetic is useful to you, subscribing is what keeps it coming. That is the whole ask, which is why the honest downsize fails the way it does. Sell, buy at $340,000 instead of $500, pay the $10,200 in buying costs, put the remaining $185,000 down. Your payment falls to about $996, and your carrying costs on a smaller house drop maybe $3,200 a year. That is a genuine improvement, and I am not going to sneer at it. But at year 15, you own an asset that is roughly $249,000 smaller. Credit yourself everything that improves. The payment drops $269 a month, the carry another $267, and $536 a month at 8% is about $185,000 by year 15. The smaller loan also leaves you owing about $18,000 less than column A. Net worth still lands about $46,000 behind. Better cash flow, worse balance sheet. Those are different goods, and blending them is how people talk themselves into moves. And the failure points straight at the fix, which is going to feel wrong. Same $340,000 house, but put 20% down, $68,000. Pay the $10,200 in costs, and push $116,800 into the market on day one. You carry $272,000 at 6.65%, $1,746 a month. At 8% nominal, you are still about $20,000 behind keeping. At 10%, you are roughly $83,000 ahead. At 6%, you are $99,000 behind. The crossover sits near 8.5%. So the only version of selling that beats keeping is one where you deliberately borrow more at a worse rate on a smaller house in order to get capital into the market on day one, and it requires the market to clear about 8.5% for 15 straight years, which means your job changed. For 30 years, the job was accumulation. Pay it down, hold on, do not touch the equity. That instinct is precisely why you are sitting on a 3% note and a $500,000 house. It worked. It is also finished. The job now is allocation, deciding what work that loan performs for the rest of your life. And the cost of staying in the old role for another 15 years is about $375,000 or $25,000 a year of equivalent saving, paid whether you decide anything or not. The house is either a wealth decision or a lifestyle decision. Pretending it's both is how the math breaks. Keeping wins at 6% and at 8%. Selling wins only above roughly 8.5%, and only in one structure. One case needs the market to cooperate. The other one doesn't need anything. So the question was never what your rate is. It is how many more years you are actually staying under that roof, because that is the only input that prices what you are holding.